A, for example, wanting 15 million, B, for example, wanting 3 million, C, for example, wanting, say, 4 million, call these 5 million like that. So you add these three, 5 plus 3 is 8, plus 4, we are talking of 12. So there is no way we'll be able to implement the three competing projects simultaneously, given that our capital which is available is 10 million. So then we need to plan. We need to analyze the viability of these projects so that we get to select like 2 projects which will be the most profitable, which will be the most viable, that we can do what here we can afford. So basically, as Raymond told us, this concept of capital budgeting is a process of decision making, getting to choose between these 3 projects I mean here, which ones will be the most profitable that will be able to fit within the capital that we have here, Now, ladies and gentlemen, I know in section 3, most of you dealt with capital budgeting techniques. Who is able to remember these capital budgeting techniques more so? Those techniques that are geared towards assessment of viability of the projects. Who is able to remember any 2? Methods of assessing the viability of projects. Who is able to remember any? Sorry for disturbing you a little bit. You know, I have to make this thing engaging. And also I use these at least to gauge you, to be able to see how many of us came from universities and were exempted from doing a FEM of section 3. So the capital budgeting techniques, what do we have there?
Say the
IRR, internal rate of return. I like that. Internal rate of return is one of the key tools of capital planning and budgeting.
The majority, 3% NPV.
Net present value, NPV. Remember, the higher the NPV, the better a project is. Thank you very much. I can remind you one, payback period. So if, for example, you invest like 10 million in a project, and we have got, so if, for example, we have got this capital of 10 million, if we have the capital of 10 million here, and in these 10 million, ladies and gentlemen, somebody tells us to go for 2 projects. We have A, which will be able to pay us back. A will be able to pay us back, say, within 3 years. We have recouped all our capital investment. And then we have B, which will take 5 years to pay us back all our investment. So in terms of payback period, if the 2 projects, of course, we can afford to buy, or rather to, we can't afford them with the 10 million, we can only afford one. If you're told that you can only afford one, A or B, on the basis of payback period, which project will you go for? On the basis of payback period, which project will you go for? So somebody has told you 10 million. You want project A, you want project B, but you can't afford both. So you've gone ahead to analyze, to do the appraisals, and you've decided here to calculate their payback periods. Where A, you've realized A will take you 3 years, payback period of 3 years. B, payback period is 5 years. So which one is better between the 2? Most of them are saying A, yes, because the shorter the payback, the better off we are. Remember, risk increases with time. The more the bigger the payback period is, the more uncertain things will crop in between here. So if you can get a project that you are able to invest in and the payback is like almost there and then that project is the best. The shorter the payback period, the better off we are. Thank you very much. How about profitability index? Is there somebody who spoke of profitability index there? Profitability index.
Yeah. Peter,
profitability index. PI. Profitability index, PI. Now, ladies and gentlemen, To us in section 5, those things we have mentioned are obiter dicta. They are just by the way. As here, we are required to study what we call advanced capital budgeting, although we'll be getting some questions touching on this, but ours basically is advanced capital budgeting, where basically we are required to introduce probabilities. We are required, ladies and gentlemen, here to introduce probabilities. We are required to introduce uncertainties. And of course, here, under advanced capital budgeting, there are two environments that you're supposed to know. Here, talk about there being two environments. There are two environments. There are two environments under advanced capital budgeting decisions. Number one, we have environment of risk. Environment of risk. Environment of risk. And if you can recall from your section 4 quantitative analysis, environment of risk is that environment where probabilities of the states of nature are given. And the risk environment, we are saying there that probabilities of the states of nature, probabilities of the states of nature are given. Probabilities of the states of nature are given. So exercise. If, for example, you are given some returns of X in form of percentages, and then they have given us three states here. They have given us state A, state B, state C. And then we have probabilities. We have 0.3, 0.2, 0.5. And then they give us like say 10, 20, 30 there. So we are required, ladies and gentlemen, to determine, number one, expected returns. Expected returns. Expected returns are the ones in section 4 QA we used to call expected monetary value. Expected monetary value. That is number one. And then number two, ladies and gentlemen, we are needed here to compute the standard deviation. Compute the standard deviation. And then number three, the coefficient of variation. I hope you are adding students who want to join us. Coefficient of variation. Coefficient of variation is popularly abbreviated as CV. It's popularly abbreviated as CV. Popularly abbreviated as CV. So remember here they want us to give them expected returns. These are X without an E. These are returns of security X. Returns of security X. They are actual returns of security X. And then number one, they want us to give them expected returns. Number two, compute the standard deviation. And then number three, coefficient of what here? Variation. So number one, it will be very important for us to appreciate the fact that here we are in the under which environment? Environment of risk. Environment of risk because of what here probabilities of the states of nature have been provided. Probabilities of the states of nature have been provided. Quite common in our exams, and it also forms a big base in advanced FM, also in advanced MA. Advanced MA, because when you go to portfolio, you get this arrangement there. You get this arrangement there. So, ladies and gentlemen, can you kindly get us started by giving us the way to calculate these expected returns? Who is able to show us how we will compute these expected returns? How shall we compute these expected returns? How shall we compute the expected returns? Is there somebody who has attempted giving us any answer there? Expected returns?
Apply.
Yes.
Rex
times probability. So what Abdullah is telling us is that for us to be able to get expected returns of X, this E stands for expected returns of X. According to Abdullah, we should come and take the actual returns of X times probabilities times probabilities, and then at the end of the day, we sum them. We sum them. In the environment of risk, ladies and gentlemen, we shall really be incorporating the risk factors into our cash flows. We shall be taking the probabilities given times the actual returns. So like what we are saying here, the expected return here will be equal to take this 10 times its corresponding probability of 0.3 plus take 20 times 0.2 plus take 30 times 0.5. So please give us an answer. Please give us an answer. Give us an answer. Now from there, what figure are they able to give us? I wonder how you guys were able to hear me and yet my microphone was off, eh? Sure. So are you able to get me now loud and clear? I want to believe it's much better. It must be much better, much better. Thank you very much. So expected returns, we are computing them. We have here 10 times 0.3 plus 20 times 0.2 plus 30 times 0.5, which at the end of the day gives me 20 what here? 22, which gives me 22, which gives me 22 here, which gives me 22 like that. So that is expected return. How about the second one, where they want us to give them the standard deviation? Number two, they want us to give them the standard deviation, which professionally we write like that, 0, and then we pull a tail. So they want us to give them the standard deviation of X. I would want to see whether there is anybody who is able to give us an answer there, the formula. And please, the girl child, girls are never left behind at all. Today, I don't know what is happening because I've had Raymond speak, I've had Abdurai speak, not heard of any girl child here speaking. Girls are never left behind. In any of my classes, let this not be a unique class. Is there anybody who has a formula there? Just in brackets, what do we have there? times Okay. Now look at this. Look at this. It is a standard deviation. Deviation means what? A difference. Deviation means difference. So our difference, ladies and gentlemen, is difference between what? Between the actual returns and the expected returns. So actual returns like that and the expected returns like that. And remember, for us, the standard deviation is a special deviation. We must come and do what the difference is, we square them. And then now we have the probabilities being introduced. And then, ladies and gentlemen, remember that these deviations are many of them, so we must come and sum them up. So and once you sum them up like that, that total figure that you have will be called the variance. And remember, out of variance, for you to get standard deviation, you need to come and say what here? Square root like that. You need to come and say square root. You need to come and say the square root, yes.
Januay did that.
Okay. Okay. Thank you very much. Thank you very much. So please look at what I'm doing. I don't want you to cram from the standard deviation from the square root. No. I remember what they used to tell us in high school. In high school, we used to say that standard deviation is root mean square. Root mean square. Root mean square. And we used to start from here, the squares. So first of all, we get the deviation. We square them. And then for a mean averaging, we multiply them with probability. Sum them, of course. and then we end by getting what here? The root, the square root. Now, ladies and gentlemen, what I would want you to do for me, I would want you to come here right away, give us a column where we capture the deviation first. Rx minus ERX, we square this, times probability. So I'm trying to follow this. The square will come in much later after summation. So I'm working with body mass. So we have Rx minus ERX. So what is Rx here? Rx is 10. So the first one here will be 10 minus ERX, which is 22. I come and square this. I multiply this with the corresponding probability, which is 0.3. From there, we have the second actual return is 20. So we have 20 there, minus expected return that we got up there, which is 22. We square times probability, which is 0.2. And then we have the last return, actual return there, which is 30, minus 22. We square this times the probability, which is 0.5. So please give us answers. Give us answers. So what we have here, open brackets. So the first one is 10 minus 22. We square this times 0.3. Is there somebody who has gotten 43.2? The first one, 43.2. Abdullah, thank you very much. Go for the second one. The second one, what do we have here? And you see these questions are quite popular in your past papers. Very popular. I'll take you to your past papers, we'll go to see. 20 minus 22. We square this times 0.2. Somebody must have gotten 0.8. And then the last one, now we have 30 minus 22. You square this times 0.5, which gives me 30 what here? 32. And now look at this. This one here, they want us to do what? To sum them up. You sum all these figures up. So please come and give us what we call the total variance. Give us what we call the total variance. So total variance 32 plus 0.8 plus 43.2 equals. Is there somebody who has 76? Yes. 76, thank you very much. 76, thank you very much. Now, ladies and gentlemen, from there, don't forget, we haven't reached Canaan. What we want to do, ladies and gentlemen, is to come and take out the square root of the variance for us to be able to get the standard what here? Deviation. The standard deviation equals square root of the variance. Square root of the variance, what figures are? Do they have the 8.7? 2. Thank you very much. Do you have any girl child who's not participating really?
I think it's Rania Agal.
It will be very hard for me to judge that. Okay. Thank you very much. Let's continue. Now, ladies and gentlemen, we have been able to get the standard what here? Deviation. We've been able to get the standard deviation. Once you give me the standard deviation, the next thing will be for us to get number 3, the coefficient of variation. The coefficient of variation, popularly called CV. And I would want to get from you, great students of mine, what is the formula of calculating CV? What is the formula of calculating CV? What is the formula of calculating CV? I'm waiting to hear from you. What is the formula of getting CV? Live.
EMV stroke STD DEB.
Okay, that's okay. I've understood.
Then Rania. STD. Last guys. DVN stroke ERX.
Okay, okay. Ladies and gentlemen, CV, to get CV, this should not be a big problem because we normally say that to get CV is always obtained by us talking over sex in percentage. Sex in percentage where sex is gender. Boy, girl, boy, girl, boy, girl. So ladies and gentlemen, meaning that for us to get CV, we normally take the standard deviation divided by x bar. X bar is the mean. What you could hear those two gentlemen talking about expected returns. So basically, x bar is the mean times 100. If my cameraman can see me up to here, CV will be equal to standard deviation all over ERX times 100 times 100 times 100 times 100. So now please try to plug in the figures. Try to plug in the figures. The standard deviation that we have here is 8.72 divided by ERX. ERX, what do we have over here for ERX? ERX, you guys gave me a figure of 22. You gave me a figure of 22 times 100 times 100. So 8.72 divided by 22 times 100. What figure do we have there? Somebody. Divided by 22 times 100. The figure that we have there is that somebody is getting 39.6. Thank you very much. 39.6%. 39.6%. Now let me ask you a question, and a simple question for that matter. Let me ask you a very simple question, and a simple question for that matter. If you're given two projects here, A, you're given B, and then they give you CV of 20%, and then B 30%. So two projects with CVs have been given there. Which project will you go for? Which project will you go for? A 20%, B 30%. Which project will you go for?
Some are saying B, some are saying A.
Hey, is there anybody who's giving a reason?
No.
Ladies and gentlemen, remember basically they hire the CV, they hire the risk. And if the examiner defines the risk attitude for us, you'll get in most cases, the examiner telling you that the investor is a risk taker. So if the investor is a risk taker, then automatically we should always advise this person to go for a risky venture. So like now here, between A and B is more risky. B is more risky, A has got less risk. So A will be recommended to investors who are risk averse. If you're told that an investor is a risk averse, recommend to them projects with a lower CV. If the investor is a risk taker, always recommend to them projects, in this case, ladies and gentlemen, that are what here, which have a high CV, So in this case, it will be very important for you to say if the investor is a risk taker, advise them to go for B. If the investor is a risk averse, I advise him to go for what here for A. I hope that is clear. So environment of risk over. We go to environment of uncertainty. Environment of uncertainty. Environment of uncertainty, you can remember very well, under this environment, ladies and gentlemen, probabilities are not given. So B, environment of uncertainty. And for us, the most important thing is to appreciate that no probabilities under this environment. We don't have any probability, no probabilities. Probabilities are not given. So what will happen, ladies and gentlemen, here is that somebody will give you returns of X in form of a percentage. He'll give you 5 here, he'll give you 15, and then he'll give you 10. Then we have, of course, the states. The states are 3. We have A, B, C. The states are 3 ABC. The states are 3 ABC, and then you will be required, number one, you give us expected returns. Number two, you give us standard deviation. Number three, you give us the CV, the famous CV, the famous CV, the famous CV. So here, I don't have to talk about anything. The most important thing that you're supposed to know under this, ladies and gentlemen, is that we do not have probabilities. We don't have probabilities for our states of nature. We don't have probabilities for our states of nature. We don't have probabilities for our states of nature. So then how do we get expected returns? I want to give you a minute. This is supposed to be a communal class. It's supposed to be a communal class. And you have this examiner wanting you to get expected returns. I mean, what do we do? Is there anybody who has an answer there? Nobody for now, right?
Raymond's 30.
Raymond is 30. What these students have known is that for us to be able to get expected returns, what we need to do is to come and give them the total returns, and then we divide them by what year? The number of those returns. So total returns divided by number of returns. So in short, you come and talk of the summation of returns of X, summation, not E, all over N. So come and add the total. The total, if you add the total, you get 20 plus 10 is 30. And how many numbers have we added? 3 of them. So then this will be 30. This will be 30 divided by 3 numbers, which will end up giving us what here, somebody? 10 as the average. Remember, expected return is the same as what here? Average. It's the same as the average. The average is there anybody who got 10 there? 10, many of them. Thank you very much. Now, ladies and gentlemen, we go to the second bit. The second bit, they want us to calculate the standard deviation. They want us to give them the standard deviation of X. Is there anybody who has an answer for this formula? Standard deviation of X. Please try out to give us the standard deviation of X. Give us the standard deviation of X. Give us the standard deviation of X, the standard deviation of X. Pata potea. Is anybody who has a formula for standard deviation there? We reward them. Ahmed, eh? We talk about Rx according to Ahmed minus ERX. At 8, because we have X, it has to be X. It has to be X. No problem. So we have Rx minus ERX. That is the difference, the general difference. But remember, this general difference here has to be squared, isn't it? Has to be squared. And ladies and gentlemen, now this time around, we don't have probability. So what do? We don't have probability. So the only thing we need to do is to come and then get the total. And then this total, come and average it. How do you average it? You subtract, or rather you divide by n minus 1. You divide by n minus 1, and then at the end of it all, we have our famous square root there. Please mark here that we are subtracting what here? We are subtracting that 1. We are subtracting that 1. We are subtracting that 1. Now, a good question will be asked, how comes in financial management, when we are getting standard deviation, we normally take away 1 from n? In finance, we must always take away 1 from n here, because in finance, when you are not given probabilities, the sample has to be small. We have a small sample. We have a small sample. And for all small samples, you don't divide the standard deviation sigma with just n, you divide by n minus 1. Meaning that we have lost a degree of freedom when we computed expected returns. We lost a degree of freedom, but you don't want to go to all that extent, because here we are not doing pure mathematics. Ours is more of an application. Ours is applied mathematics. These guys here discovered formulas for us. What we need to know is how do we apply them? How do we apply them? How do we apply them? Now, ladies and gentlemen, having discovered this, then what I need to do is to come and create a column up here of Rx minus ERX. And then we do what here? We square. We don't have probability. Any question that has probability is a good question. So there is no question, or there is no probabilities here. There are no probabilities here. So we have our actual returns, 5, 15, 10. We say minus. Expected returns. Expected returns, you guys are giving me a figure of 10, 10, 10, like that. So we'll come and do what to these ones? We'll come and square them times the probabilities. Probabilities are not given. You can even see myself here, I'm so much used to probability, they're not given. So what you're supposed to do is simply to come and give us these parameters from your calculators, and I expect a good student to give me the first parameter. You open brackets, 5 minus 10, you square. You square, give me a value there. 25, eh? 25 positive, isn't it? So many students here will write negative 25, and I know why. Because they do this thing in their mother tongue, they'll say 5 minus 10 is minus 5, and then when they square, no, any number squared like minus 5 squared is the same as minus 5 times minus 5, which will give me 25. How about the second one? The second one is as well, is 25 as well. And then, of course, we have the last one being 0. And if you look at this formula very well, after you've gotten this deviation squared, come and add for us. Add for us, what do we have here? Somebody, we have 50 there. When you add for us, we have 50 there. We have 50 there. So then come and plug in everything in the formula. So we have here, the total here is 50 divided by n, which is 3, 3 minus 1. 3 minus 1, 3 minus 1, 3 minus 1. So we have there 3 minus 1. Can somebody talk to us tonight? What do we have there, ladies and gentlemen? What is the final answer?
5.
They're getting 5, isn't it?
Yeah.
They're getting 5. Thank you very much. And I expect good students like yourselves to move a notch higher and give us the answer to part 3, where they want us to give them the CV, coefficient of variation. And please don't forget my formula. Don't forget my formula of coefficient or variation, quite an interesting formula. Is that okay? What figure of CV are they getting? Yes.
Let's giving us 50%.
50%. Who is that?
Abdullah.
Abdullah, 50%. So what Abdullah has done, in this case, he has taken the standard deviation of 5 divided by expected returns, which was 10 times 100, which gives us 50%, which gives us 50%. Now, ladies and gentlemen, have they ever tested us on these things in our exams? Oh, yes, severally. Please get out your past papers, and I would want us to go to November 2016. Question number 2. November 2016. Question number 2. Boy, Moses Mapesa. Moses Mapesa. Moses Mapesa. Moses Mapesa. Moses Mapesa. I hope we have our past papers with us. They've given us Moses Mapesa. Moses Mapesa is in the process of evaluating investment in 2 companies whose percentage returns in the last 10 years, perhaps I could copy this for you. In the last 10 years, they have given us the percentage returns. They have given us percentage returns. So percentage returns, we have returns of company F, we have returns of company S. They have given me the years. So years, I've decided to put this in columnar form. I like it that way. Years 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And then they have given me these figures for F37, 32. And then we have, ladies and gentlemen, 24, 29, 24, 29. And then for year 3, we have -7, -12 at the first year. -7, -12. And then we have 6, 1. Year 5, we have 18, 18, 18, 15, 18, 15. Then we have 32, 32, 32, 30, 32, 30. And then we have -5, 0, -5, 0. And then year 8, we have 21, 18, 21, 18. And then year 9, we have 18, 27, 18, 27. And then year 10, we have 6 versus 10. 6 versus 10 like that. And then we are needed to do something very easy. They want us to give them the correlation coefficient. They want us to give them the correlation coefficient. They want us to give them required. They want us to give them the correlation coefficient, cognizant of the fact that they have not given us any probability. No problem. So we are in which environment? Uncertainty environment. So I must know how to get the mean. I must know how to get the standard deviation in this environment. So I want you guys to do me a favor. Please come and give me the totals. When I want to get the mean, I'll take the total parameters, the total returns, I divide by n. So please add downwards, give me that. Even if I don't know what I'm getting, whenever I see many terms like this, I'll get the total first. So please give me the total. Give me the total. mute me. So they are getting the total returns here. They are getting total returns for the two. This one here, they are saying is 100 what here? 150. That's for F. How about the second one, total returns? Is there somebody who is able to get 150 here? Both of them should be 150. True? Both are 150. Thank you very much. Now, having gotten the total returns, then I will very easily give you expected returns of F. Expected returns of F. So expected returns of F, what do we have here? Expected returns of F, we'll take the total returns. Total returns of F, you can see it's 150 divided by number of items. The number of returns you added, number of years, here they are 10. When getting expected returns, we don't say minus 1. When getting expected returns, we don't say minus 1. You will take 150 divided by 10 like that, which gives us 15. And then we have expected returns of the second security, which will also be 150 divided by 10, which gives us 15 like that. Now, ladies and gentlemen, there is no way I can get correlation coefficient without getting the standard deviations. So I expect you, great students of mine, to come and give us the standard deviation of F. Give me the standard deviation of F. How do I get the standard deviation of F? It's quite easy. The standard deviation of F, ladies and gentlemen, will be returns of F minus expected returns of F. And then we do what here? We square. If I had probability, I would be very happy, but there are no probabilities here. So what I need to do is to come and get the total there. And then at the end of the day, average this by dividing with n minus 1. And then, of course, we have the concept of what here? Big square root. Concept of big square root. So now I expect you guys to move with a high speed and give me the standard deviations. Why are you dividing these with n minus 1 and not n alone? I told you in finance, whenever you're not given probabilities, the examiner will always give you small samples. Small samples are samples whose n is less than 30. Less than 30. But unless this examiner is another one, I've never seen that. Where an examiner gives you information without probabilities, and then he goes ahead to give you 30 numbers or 40 numbers, that is not a good exam. I've never seen that personally, never. And that is why we say that for standard deviation here, we shall always be dividing with n minus 1. So please give me the answer there. Give me the standard deviation of F very fast. Just generate your tables very fast. I'm giving you 10 minutes, both of them 10 minutes maximum.